Good morning, everybody, and thank you so much for joining us this morning. It was lovely to have so many people on the call for what will be, I'm sure, an insightful update from Dougal Maple-Brown, who is the head of Australian shares from Maple-Brown Abbott. Welcome, Dougal. We're looking forward to hearing your insights today. And you know, obviously, a lot of very important market dynamics have been happening over the last few years, particularly for you know, a manager with a distinct value style. And so it should be looking forward to your comments and presentation, Dougal. This morning we will be focusing on a couple of things, which is looking at the current market environment and outlook, but also importantly diving into the recent performance and positioning of the Maple-Brown Abbott Australian Share Fund, which has had a very strong period of performance, which has been wonderful. It is with some sort of regret and sadness that I say this is the last webinar that Ironbark will be doing with Maple-Brown Abbott for the Australian Share Fund. Maple-Brown Abbott a number of months ago have made the decision to build out their distribution capability internally, and so the responsibility for distribution of the Maple-Brown Abbott Australian Share Fund will be transitioning back to Maple-Brown Abbott. And Dougal, I know we've known each other for a long time now. We've been absolutely delighted to be representing such a a flagship strategy in the market with such a long history, and so Maple-Brown Abbott have recruited Vijay Srinivasan from CFS. I know a lot of people will know him from the market, and so so you will see from the beginning of next year, Maple-Brown Abbott will be servicing you as it relates to this fund. But been a wonderful relationship, and one we hand over hopefully in great stead to you guys, and best of luck for the future. And I think, and I'll let Dougal will talk a little bit more about it later, but it also reflects the strategic priorities of Maple-Brown Abbott, who have, more recently designed a new, more concentrated Australian share fund called the Australian Share Value Opportunities Fund, which I think Dougal will mention. And so, a really good new strategic era for Maple-Brown Abbott on the distribution side. So we wish them the best of luck, and so on. But I will stop talking. The webinar should be about 45 minutes long. There is the opportunity to ask any questions you like. Please do so through the Q&A panel, and I can present those to Dougal along the way. So with that, over to you, Dougal.
Thank you, Alex, and good morning, everybody. Just before I jump into the pack, I just want to say a couple of things. First of all, it's been a very strong period for the fund, so there's nothing to worry about in terms of numbers over both the quarter and the year to 30 September. In fact, over the 12 months, the fund's outperformed the market by around 10%, which is clearly very pleasing. We'll come to the numbers later, but I don't want people worrying about that. And the second thing I'd like to say up front is that notwithstanding the very strong performance, we still see a lot of upside in value in our value approach today. Effectively, the valuation dispersion is still exceptionally wide, and we can exploit that opportunity on behalf of our investors. So with that, I'll jump into the pack. I've started here with interest rates because I think the story for many asset classes begins with interest rates. So the brown line there is the nominal yield. This is a developed world sort of amalgam, and the blue line is the real yield. And you can see both of them start top left and end up bottom right. The nominal yield at 8 or 9% going back to the 90s and going to zero, and the real yields peaking at about 2 or 3% and now going to about -2%. Why does this matter? Interest rates, of course, matter for all asset classes, and falling rates have been a boom for all asset classes. And so we have share markets at all-time highs, we have bonds trading at very low yields, we have REITs, infrastructure, all have benefited from these low rates. But as I said a couple of times, within asset class, and now I'm talking within Aussie equities, interest rates impact different stocks in different ways. And effectively, the lower the interest rate, they more benefit the long duration stocks. And in this market, that's been growth stocks. and to that extent, the falling rates have been a headwind for value for many, many years. And to be frank, it's been a tough decade until relatively recently. What's the point of all this? The point is, as you've heard, indeed, central bankers around the world debate about whether the recent inflationary uptick is for real or transitory. We're more in the first camp. Undoubtedly, there are some bits of it that are transitory. We were joking with Alex before the call started about the used cars and the puppies. Maybe some inflation in those. I'm not sure they're asset classes, but those goods is transitory. But on the whole, we believe inflation is picking up, in which case yields will start to rise, which they have, in which case we as value investors will benefit to the detriment of growth in an asset class sense. And frankly, given value has been one of the only underperforming assets over the decade, correlated negatively with falling rates, we actually think value could be one of the very few asset classes that could do okay in a rising rate environment. Turning now to a few of the anomalies which we've seen over the last little while. This is a funny chart in a way, but it just shows you some of the crazy things that are happening in the world over the last few years. So the blue line is price to sales of the NASDAQ, so a tech-heavy index in the US. And you can see it's bounced around sort of 1-2 times for several decades. And over the last year or two, it's gone ballistic and peaked at roughly 4.5 times sales. And don't forget, many of those NASDAQ companies aren't profitable, hence why we're using valuation metrics, and I use that in the widest sense, price to sales rather than price to earnings. I contrast that with the brown line, which is the Australian energy stocks relative to the industrials effectively. So it's EV to EBITDA, so it's cash flow of the energy stocks versus the cash flow of the industrials. And you can see the energy stocks have been totally derated. And the final point I'll make is that those energy stocks are generally, particularly at current commodity prices, spitting out a lot of cash, whereas the NASDAQ, as I said before, many of them are unprofitable and consuming a lot of cash. So it doesn't seem to be, and hence the title of the chart, cash doesn't seem to matter on the NASDAQ, which are consuming cash, but nor does it matter in the Australian energy stocks, which are frankly spitting it out. Australian market, I always break into 3 buckets. The industrials generally, the banks and resources, and over time they're roughly a third. We're still pretty concerned about many of the industrial stocks, and this is the chart of the high PE firms, which are all industrial stocks of our market. Again, a very long-term chart. Effectively, the average for the top quartile of PE stocks in our market has been about 25 times over time. And a bit like the NASDAQ chart I showed you previously, it went vertical about 18 months ago, coinciding with the start of COVID. It came down a bit and we did a bit better, but it's gone back up again. Basically today, the top stocks in the Australian market are trading on 50 times, on average, 50 times forward earnings. Not surprisingly, we don't own any of the stocks in that bucket. With inflationary concerns, and we're definitely in this camp, people are trying to position their portfolios with some protection. This chart shows you within the Australian equity market which sectors have done poorly or well as inflation rises. So the way you read this chart at the very top there, healthcare, that underperforms when inflation is rising. Not surprisingly, we've got very little. We've got one healthcare stock basically, and we're heavily underweight. On the other end of the chart, you can see energy, metals, which is basically materials, and steel stocks, positively correlated with rising inflation. And again, it won't surprise you to know that our portfolio is heavily weighted towards those sectors towards the bottom. Again, providing some sort of inflation protection if, and we would argue when, inflation keeps rising. Turning to resources, we've been big on iron ore for the last couple of years and done well. I've actually sold out of most of my iron ore stocks 6 or so months ago. They've been spanked since, and frankly, they're looking interesting again as we speak today. The one sector which has clearly lagged has been energy, which is code for oil, gas, and dirty coal in Australia. This chart on the screen now plots the oil price, which is the brown line, dollars per barrel on the right-hand axis, and the Australian Energy Index on the left-hand axis in blue there. And you can see, and not surprisingly, the energy stocks, the index, has largely followed the underlying commodity price. And again, to our value philosophy, we like to buy the commodities, so the commodity stocks when the commodity itself is trading below our long-term view, and sell it when it's trading above it. So the stocks have generally tracked the underlying commodity, being oil, but you can see a big wedge has opened up over the last year or so, and we can have some interesting debates. Well, perhaps over a beer or a coffee later, but we can't do that these days. Hopefully when I can see you all again, as to why that gap has opened up. But a significant gap has opened up between the performance of the energy stocks and the underlying commodity. And that to us looks like a pretty big opportunity. You can see the blue line there has gone up over the last 3 or 4 months. So the energy stocks have played some sort of catch up, but clearly the stocks are not pricing by any way, shape or form the underlying commodity, which you can see for long periods of time they have, and hence why we remain overweight energy. One of those stocks is Woodside Petroleum. It's been in the news quite a bit recently for a variety of reasons. It has done okay over the last 3 months, but again, a bit like the previous graph, it's been a poor contributor over the medium term. The chart here on the top right, JKM, is the Japan-Korean marker for LNG. So it's the gas price effectively. It's gone vertical over the last little while, but Woodside share price clearly hasn't. It's now trading a long way above what we think is fair value for that commodity, for gas. However, in this case, the stock price hasn't reacted at all, which is interesting to us. And Woodside remains a core part of the portfolio. We're on both sides of this transaction. Some of you may know BHP Petroleum are effectively spinning out their business into Woodside. So we're still long BHP as well. So we'll be further along Woodside when that deal goes through, hopefully in the first half of next year. It'll be good for Woodside. It diversifies their portfolio, adds some of the assets in the Gulf of Mexico from BHP, add some short-term cash flow from places like Bass Strait, which will be useful in funding some of Woodside's longer-dated development projects. Third sector of our market are financials, and we are and have been heavily overweight financials for the last little while. Obviously, the biggest bucket of the financials are the banks. We went overweight banks about 18 months ago, not quite at the bottom, but pretty close to the bottom of the COVID, I won't say panic, but the COVID doom and gloom. The banks have clearly had a fairly big bounce since then, but you can see on the chart they bottomed at roughly 1 times book value. And again, I'll go into the composition of our bank portfolio, which again, for people who've heard me for a long period of time, we held no CBA and overweight the other 3 majors. So if the sector bottomed at book value, our 3, so ANZ, NAB and Westpac, all bottomed at a discount to book value. I think ANZ maybe at 0.7 a book, maybe NAB and Westpac at 0.8 book. So they were very cheap 18 months ago, which is roughly when we went overweight. It's been a good story since, as the banks have rallied strongly. The sector back to 1.5, but again, I'll come to CBA in a minute. That's significantly well above 2. So the others aren't at 1.5 yet. The others are more like 1.2, 1.3. The ROEs of the sector going forward will be lower. The sector holds more capital than it has historically. Margins are falling, largely due to competition as well as low rates. So maybe they won't go back to the average like they do on this chart, but we still think that the banks picking up decent dividend yields along on the 3 cheaper ones are a good place to be. The one we don't like, and we haven't for a while, and thankfully this has reversed even since the quarter end, frankly, over the last month or so, is CBA. CBA valuation is still mind-blowing in our view. It's roughly 20 times earnings. It's about 2.5 times book. These charts are always fun. I've done them several times when things get a bit stretched. This time I've taken from Citi. This is about a week or two old now. CBA's market cap at roughly 170 billion Australian dollars was coincidentally the same market cap of ANZ and NAB combined. So buy one bank, CBA, or get two banks, ANZ and NAB. And you can see on the right-hand side of this chart, and again, these are Citi earnings, not my forecast, which you might say I'm a bit biased. Citi forecasts CBA to make about $13 billion next year. ANZ and NAB making roughly 20 billion Australian dollars, yet the valuations are the same. So that still seems to us a fairly big anomaly. Again, turning to the next chart, you can see the outcome of that effectively. The left-hand side is CBA's price to book premium compared to the other banks. So it has traded at a premium, and so it should. Its return on equity is higher than the other ones, although to be fair, it's actually less higher than it was previously, and yet the premium at roughly 80% on a price to book basis or 50% on a PE basis is extremely elevated. So the ROEs come back to the pack, yet the valuation premium has in fact expanded. So we can't justify CBA, and hence why I don't hold any. The other part of the financials is broadly the insurers. And for the first time in my investing life, I'm now long all three general insurers. So QBE and Suncorp have been in the portfolio for a while now. IAG is a very recent addition. So let's first of all go to the big picture on why I like general insurance. So first of all, revenues, which is premium, is growing. And anyone who has paid their house or car insurance anywhere across the country over the last 12 months can testify that. And secondly, and this is a bit here and now, and changes almost day to day or week to week, but obviously on the East Coast here, we've been through several months of lockdowns, both in New South Wales and Victoria. And during lockdowns, a couple of things happen. First of all, your car doesn't generally leave the garage. If your car doesn't leave the garage, then it's harder to have an accident. So on the motor side, claims fell substantially. And even on the home book, people being at home, your house burns down less if you're at home. The leaky tap under the sink gets turned off rather than drips all day and floods the living room. So even home claims are down as well. So you've had the very nice situation of revenues growing, and at least here and now, costs, which are claims, falling over the last little while. Against that backdrop, IAG has stubbed its toe numerous times. And again, this is a very recent addition to the portfolio. IAG, you can tell from the top right-hand chart there, has underperformed the market by roughly 50%. It's a big number. So 130 on that chart down to a bit over 60. So that always gets our attention. Some of that is self-deserved. On the business interruptions claim, they were sloppy basically. They had poor drafting in many of their policies, referred to an old act, which hence exclusions aren't going to work. So they had a 1.2 billion provision for business interruption. And again, long before we owned it, but about this time last year, they raised about $1 billion of capital. So that didn't help. But there have been other examples as well. But when all said and done, here and now, they are still putting up prices, premiums like the other three. Claims, again, at the moment are falling, which should lead to expanding margins and expanding profits. And then finally, all three of them, as with the banks, should get a kick as interest rates go up. So the insurers hold a big pot of free money, free flow. At the moment, they're earning very little on it. Remember, the cash rate's 10 basis points. They're probably more out at the 3-year, but the 3 years removed dramatically at the moment. So as interest rates go up, they also earn more on that free flow. So the combination of higher underwriting profits and higher investment returns effectively looks a pretty good outlook for the insurers. We don't think they're particularly expensive in a fairly expensive market. As I say, for the first time in my investing life, I'm overweight all three general insurers. Just got two more slides on the market. I just wanted to briefly talk about our ESG process. And part of this is my personal reaction to what's been happening in the world, both at Glasgow and COP26, but also, frankly, a bit of greenwashing in my industry, which frankly annoys me and is not helpful to anybody. So this is what we have done at Maple-Brown Abbott in Aussie Equities for some time now. We signed the UN PRI in 2008, so almost 15 years ago. We've had a dedicated ESG analyst helping our Aussie equity team for over a decade now. So this is not something that we've done, yesterday or last month or last week. This is something we've been doing for a very long time. And as I've said publicly many times, we've voted our proxies since my late father founded our firm, don't say too quickly, in 1984. So at least on the governance side, I can say we've been doing it since day one. Just quickly, what do we actually do today? And so first of all, in this fund, and indeed the one I'll talk about in a minute, we do not screen for ESG considerations. Okay, so we are not pretending to be a green fund for want of words. What we do is look, so in the identification section, look for material ESG issues. That's generally not too hard. The harder bit is the second bit, which is how you value effectively those ESG issues and how you put that through your forecasts, either in your earnings or, frankly, more commonly, how you adjust your terminal value or your terminal discount rate to take account of things which are going to happen sometimes a long time in the future, which are very hard to quantify in an earnings forecast. And then finally, the third box there, the engagement piece. Again, you can see proxy voting down the bottom there. But we do extensive engagement with our investee companies. And it's this I'll talk to briefly on the next slide. We committed to, over a decade ago, to 10 dedicated ESG meetings with our investee companies every year. So just to be clear here, we generally see the management teams twice a year after reporting season, whenever that is. We also generally see the chair, generally pre-AGM. And these meetings on the screen in front of you are additional meetings over a whole range of factors, which we listed on the last slide, whether they be climate or whether they be governance, whether they be remuneration. And these are additional meetings, and I say in addition to the management meetings and our chair meetings, which we hold every year. And what's the point of these? It's to encourage shareholder-friendly outcomes for our investee companies and hopefully to have a two-way conversation with many of them. And that's what we do, and hopefully that was useful for people understanding what we actually do rather than what some people say they do. Turning now to performance. This is what's kept me awake at night for the last 10 years and lost the last of my hair effectively. So this is global now, value versus growth. When that line's going down, which effectively has since the GFC, value is losing. Which coincides with that fall in interest rates where I started the webinar this morning. Yes, it's been a very tough decade basically. Value has picked up over the last 12 months or so, but frankly you need almost a magnifying glass to pick it up in that bottom right hand corner. And then frankly the last week or month or two has been poor again. But it's been tough, and my point here is that frankly this is the start. What's the start? So these are the Australian share fund numbers. Gross to 30 September, and you can see very strong numbers, absolute and relative over both the quarter and the year. But again, there's a hole to fill over the 3 and 5 years, which we're only just starting to fill. So very strong numbers, and it's always 2 steps forward, 1 step back. October's was tough. November, I haven't got the numbers yet. I suspect will be tough. So it's not going to be linear. And things like new waves of COVID are probably not helpful, but over the long term, over the medium term, we still see that value opportunity as very wide. Turning to what's been good for us, probably most pleasing is the top of the list on the positive side there, CSL. Again, like CBA, we thought that stock was hideously expensive. Like CBA, I've held none. And CSL got its comeuppance over the year and added, not holding any, added almost 2% to the fund. Equally, and it's fair, you can see CBA not holding it cost 2%. thankfully that has somewhat reversed over the last month or two, with CBA getting spanked after a recent quarterly. But you also should point out that there's a couple of banks, or ANZ and Suncorp and Westpac, or Suncorp's insurer really, but ANZ and Westpac on the other side of the ledger there, largely evening that out. What we hold today and what we like, again, I hope I'm always true to my word. You can see the top five. 4 of those top 5 are financials. So in a rising interest rate environment, we like financials, and hence why 4 of the biggest positions are financials. All the stocks on the underweights are all naked, so we don't hold any underweight positions, whether overweight or underweight, and say Commonwealth Bank, etc., are all underweight. On the sectors, you might want to go back and compare this to that inflation chart I showed you about what sectors do well in an inflationary environment. Again, I think I'm pretty, or not think, I know I'm pretty consistent. So the biggest there, underweight, is healthcare at the very bottom there. That was the biggest loser back on that earlier slide about a rising inflation environment. So if you're in that camp like we are, healthcare is not the sector to own, and hence why we own so few of it. Flip side, at the very top of the page, materials, which are code for resources in Australia. Commodities historically have been a reasonable hedge against inflation, and there's no reason why that shouldn't continue into the future. So we're still heavily overweight materials. Probably the one which I will call out, which looks a little unusual, is that second one there, utilities. So that's largely 2 stocks. Spark Infrastructure, which has actually now been taken out, in fact delisted earlier this week, so we don't hold any today. That bar would be a lot closer to 0. And the other large stock in there, and this is a quirk of the indices probably, is Origin Energy. Frankly, that stock is more correlated to the oil price, and you've heard my position on energy before, rather than utility, albeit it does own a electricity and gas utility business as well, but for whatever reason, it's in the utilities index. What have we been doing? Probably the sales are most interesting. So Boral and Coca-Cola were both takeovers. So Coca-Cola was taken out totally, and Boral was, I think Kerry Stokes has now got 70% of it. So that's effective takeover, so we're out of that. Spark, which only happened post quarter end, is also gone. So in this environment, some of our very cheap cyclical stocks have been snapped up, which has been pleasing for performance over the time period. Of course, it doesn't leave you with less stocks going forward. The other key call out there on the right-hand side of the sales is the iron ore. So Rio totally out, is largely iron ore. BHP reducing, is largely iron ore. Sims at the very top there is a recycler, a metal basher, but effectively it trades with the iron ore price. So we exited 2 out of 3 and reduced the third one, BHP, 6 or 9 months ago, which was well done. Iron ore price peaked at about 220, 230 bucks a ton. It's since fallen to about 90. It's gone back to 100, but significantly down from its highs. And then where have we put the money? So IAG I called out. That's a new one, only over the last 3 or 4 months. So that's a new position. The other one I'll call out is South 32, which is actually one of the old BHP spin-offs. There's about 3 spin-offs now, and about to have a 4th with the petroleum going. So part of the trick has been still liking resources, but not liking iron ore. So we've added to some energy, and South 32 is a diverse range of commodities, but thankfully not iron ore. So we'll put some of our resource/commodity exposure into South 32. How does the fund look compared to the market? At a discount, as it should, and always, well, almost always will be. The market on 20 times still looks pretty hot to us. But again, to put that in perspective, of the charts I've showed you already today, the top industrial stocks are on 50 times forward earnings. All the industrials, excluding financials, are on roughly 30 times forward earnings, and the market as a whole on 20 times forward earnings. A reasonable dividend yield of almost 6% when you include franking, which again, in a context of a cash rate of 10 basis points in this country, still looks reasonably attractive to us. A bit more about this fund, and I apologise because some have seen this slide ad nauseum over the last 20 years, or the next couple of slides in fact, but it's still important. So this one's turnover. We're long-term investors, not traders. We say we hold stocks for a 4-year period, which implies a 25% turnover. You can see, in fact, it's actually lower than that. What does that mean, and what does that drive? I mean, it drives lower brokerage, so I'm not too happy with our brokers aren't too happy with us, but that's their problem, not ours. Secondly, it drives low capital gains or low realised capital gains, because of course you only realise the capital when you sell the stock. And finally, like including those takeovers where frankly you don't have a choice, when we do ultimately realise those capital gains, we've almost certainly held the stocks for over a year, and hence the ultimate investors are entitled to the discounted CGT regime. That's all real, a bit like the franking I'll deal with in a minute, which is not picked up, of course, by the pre-tax performance numbers I showed you earlier on. Franking, we like franking. Again, people have heard me to death on this. We target franking. Franking is percentage of income, bounces around over time, but it's roughly been about 80%. And then generally, of which last year was an exception, as a result of that franking, the fund produces an additional return. So this chart here, the additional return from franking, again, not picked up in the pre-tax performance numbers for the fund, somewhere between 1.5% and 2%, which is significantly ahead of the market as a whole, which are the brown bars here on this chart. It is fair, and I checked these numbers. 2021, last year to the year to June, we were lower than the market as a whole. Now, there were some pretty funny things that happened last year as a result of COVID. In terms of this fund in particular, APRA suspended and limited some of the dividends paid by the financials, particularly the banks, and also the insurers to a lesser extent, obviously being overweight those stocks, but not CBA, which for various quirks when they reported wasn't so hardly hit, was one reason. And secondly, some of the stocks that we held, some of our deep cyclical stocks, let's call it Star Casino, for example, who run the Star City, that run the casino here in Sydney, didn't pay a dividend over last year. So some of those stocks, if you don't pay a dividend, you can't get the benefit of franking. So it was unusual last year, less franking than the market. But again, I've got a 6 or 7 year history there, and I've got another 15 years before that, where we have consistently provided a higher level of franking than the market as a whole. If you'll indulge me, this is the first time in the 25 years almost that I've been at Maple-Brown Abbott, I'm talking about a new product, so I'm probably entitled to talk about it once in my life. We launched an opportunity strategy, which Alex alluded to earlier on, effectively a concentrated strategy. We launched it in the middle of last year. It literally was the absolute darkest hour. Many people, both at the time and indeed subsequently, said, what the hell were you doing, mate? But we literally saw that valuation spread so wide that we had to do something about it. So we launched the strategy in the middle of last year. It took a few months to get the fund up and running. The actual fund was launched in April this year. What is it? It's a high conviction portfolio, broad cap, benchmark unaware, and typically we're targeting an active share of over 75. It's actually been closer to 80, which limits the exposure of the top 20 and is probably the key differentiator compared to the Australian share fund. Talk a little bit about that differentiation on the next slide, and why it may be of interest to those who have a value bent. This is the market cap stratas, if you will, of our market. So the brown is the index, and again, I'm not telling you things you don't know. The Australian equity market is very concentrated, bounces around a bit, but the top 20 stocks in our market by value are between 50 and 60%. So it's a hell of a slice in the top 20, and then it tails off pretty quickly. What this fund targets is opportunities throughout the market cap spectrum. And so you can see here, we've got about 20% in the top 20, and then actually higher percentages of the fund in what I would generally call the mid-cap section, so 21 through to 100. That might be attractive to some of you. A lot of Australian investors that I see have an awful lot exposure to the top 20, whether that be through other funds, including our own, or frankly, even shares held directly from that CBA you've got in the bottom drawer for ever and a day. So this might be complementary to those people with a value bent who want a bit more exposure through the market cap structure. What do we hold? When we put this thing together, we debated this long and hard. Not the individual names, because they will obviously change over time, but the sort of weights we want in the fund. And indeed, we looked at some of our competitors' funds who have really big positions in individual stocks. And that wasn't a position we were comfortable taking. Even if we like some of the names, some of our competitors have 10% in Alumina or AMP, which we don't hold, by the way, or Newcrest or whatever. And our intention here was, yep, we're going to have to hold a couple of banks, so you've got to have some big positions there. Well, we were much more comfortable holding 3 or 4 or 5% positions, still chunky positions across a range of mid-cap companies is the alpha we're trying to harvest. And part of this is good fortune when we launched the fund, but that's been highly successful. You can see from this slide. So the strategy was launched, as I said, the middle of last year. Incredible numbers. Don't expect me to repeat them. And the fund launched earlier this year has also performed very strongly. Now, it is very, very whippy. Effectively, if the normal fund is up 1% for the month, and this might be up 2%, and conversely, if the normal fund's down 1% for the month and pounds to peanuts, this one will be down 2%. So it is a high octane fund, and that's what comes with an active share, as I say, approaching 80. But for those who want some value, particularly for those who are worried about inflation, then it might be something you want to consider for your clients. That was all I was going to say at this point, Alex. I can't see the questions, but if there are any, can I throw it back to you, please, Alex?
Thank you, Dougal. Thank you. It's a very comprehensive presentation. I think we've got a couple of questions, just more about style. And so you've obviously, talked in the past and obviously talked today about the challenges of value in a falling rate environment. How do you think that style is going to play out? I mean, you talked about value coming back. Do you think it's more just a normalized period that could see the battle between value and growth? Is it more core, or do you think a big resurgence in value? I mean, I guess it's linked to your inflation and interest rate views, I guess. But yeah, just a couple of questions on that broad topic.
Yeah, thank you, Alex. People won't be surprised at my answer. But rather than pontificate about what might happen, I think, or at least I'll start with the facts. And that's over the 12-month period where, although cash rates haven't moved, 3, 5-year and 10-year bond rates have moved substantially around the world higher. In that environment, albeit still at very low absolute levels, in that environment, value has, and you can see in the numbers, value has performed very, very strongly. So if that's your base case, that rates are going to keep going up, which is our base case, then we can point to the immediate past as to how value's performed, and we would obviously suggest that if rates keep rising, then value should continue to outperform.
Great, thank you. There aren't actually any further questions. I think you've done such a good job of covering a lot of ground, so thank you very much for that. That was fantastic. And I just want to say thank you to the audience. Thank you very much for joining us today. And Dougal, I know it's been a wonderful working relationship with you and Maple-Brown Abbott over this period of time, and we hope we're handing the strategy over with in a good position and so on, and the performance numbers are wonderful. So it's we wish you every success in future as well.
Yeah, thank you, Alex, and thank you for those kind words. Ironbark have been a wonderful partner when we brought our own fund back from Advance, effectively Westpac, over a decade ago now, and thank you to Alex and his team over the years who have been wonderful supporters. And also, and more importantly, thank you to the advisors and ultimately their clients who have stuck with us over what's been undoubtedly a lean period until the last 12 months. You can see from the numbers that you have been rewarded, but I just want to leave you the message that, if you believe that rates are going to keep rising, which we do, then the rewards should keep coming those ways of value investors and ultimately our clients. So thank you very much for sticking with us. Long may it continue. Thank you.
Thank you, Dougal. And just the sort of final words on. So as I said, we will be handing over the relationships to Maple-Brown Abbott. They have in VJ got a wonderful resource and broader resourcing within their team. So we will be sort of doing a very warm handover to their team over the next couple of months, and with a view that it's sort of taking up full time in January. So expect to hear from both of us together over the next couple of months. But as I said, Dougal, we wish you every success in the future. Thank you, everybody, for attending this morning. There will be a recording of the webinar available, and we will send you a copy of all that, plus also CPD accreditation for attendance at this morning's webinar. So thank you all very much. Thank you, Dougal, and I hope you have a great day.